Hey everyone, welcome back to The Explainer. As an experienced investor, I've seen firsthand just how incredibly daunting it can be when you finally decide you're ready to start growing your wealth. Opening up that brokerage app for the first time, it often feels like staring at this massive, indecipherable wall of ticker symbols. You have absolutely no idea where to start, and frankly, I don't blame you. Well, today, we are going to fix that. I'm going to share some seasoned strategies to help you avoid the common pitfalls and completely demystify ETF investing once and for all. Now, just a quick reminder before we get going, this explainer is strictly educational, it's not financial advice, so always do your own research. All right, let's jump right in. So, here's a tough question to kick things off. Why is your cash just sitting there? The sheer anxiety of picking the wrong fund or getting blindsided by some hidden fee is exactly what keeps so many of us frozen on the sidelines. Maybe you're terrified of buying into a fad that was super hot last year but is absolutely tanking today. I totally get it. But while you're waiting around to feel ready, something pretty insidious is happening. Inflation is quietly and relentlessly eating away at the purchasing power of your cash. Basically, waiting is costing you money. But here's the incredibly good news. Picking a solid ETF isn't some dark art. It's actually a completely solvable puzzle once you know what actually matters. We've got a fantastic stress-free roadmap for today. First, we'll cover the ETF basket concept, then our three-step filter, dive into some advanced metrics, build a three-fund portfolio, and finally, go over 5 costly mistakes you need to avoid.
All right, part one, the ETF basket.
If you're new to this, just think of an ETF or exchange-traded fund simply as a basket. If you buy an individual stock, it's basically like putting all your money into a single egg. If you drop it, well, it breaks and you lose everything. And let's be honest, picking individual winning stocks is genuinely hard. But an ETF, that lets you buy the entire basket. We're talking dozens, hundreds, or even thousands of companies in one single transaction. When you buy one share of an ETF, you instantly own a tiny slice of everything inside that basket. This gives you immediate diversification. Think about it. If your ETF holds 500 companies and one of them goes bankrupt, the impact on your overall portfolio is just a blip. It's a built-in defense mechanism. Plus, unlike old-school mutual funds, ETFs usually charge insanely low fees, they're fully transparent, and you can buy or sell them just like a regular stock anytime the market is open.
Moving right along to part two, the three-step filter.
This is the core framework you should run absolutely every ETF through before you even think about hitting that buy button. It comes down to 3 things: broad market, low cost, and big and boring. Let's break these down. Filter 1 asks a very simple question. What am I actually buying? For your core holdings, which is the absolute foundation of your wealth, you want an ETF that tracks a broad, established, market cap-weighted index. In plain English, you are buying the whole market. You are not trying to outsmart Wall Street or pick some hyper-niche theme. We're talking about funds like an S&P 500 index ETF, which gives you the 500 largest U.S. companies, or a total world ETF. Sticking to these broad funds means you're making a high-probability bet on the long-term growth of the overall economy. Now check out this number. $20,000. This brings us straight to filter 2. What does it cost? Every ETF charges an expense ratio, an annual fee deducted automatically from your returns. Because they don't mail you a physical bill, people just ignore it. But let me show you why that is a massive mistake. Let's say you invest 10 grand at an 8% average annual return over 30 years. If that fund charges a 0.50% fee, your money grows to roughly $87,000. But if you put that same 10 grand in a fund charging just 0.05%, it could grow to around $107,000. That is a jaw-dropping $20,000 difference, quite literally vanishing into thin air purely because of a tiny fraction of a percent in fees. So, your absolute non-negotiable beginner rule for your core funds is to look for an expense ratio well under 0.20%. Honestly, ideally under 0.10%. The best part is, many popular core ETFs out there today charge as little as 0.03%. There is virtually no good reason to pay high fees for a simple broad market index fund. You've got to keep those costs fiercely low. And filter 3, is it big and boring? Listen, when it comes to building your core portfolio, boring is beautiful. You want big, established funds. Why? Because a large fund, meaning one with at least $100 million in assets under management, is infinitely easier to trade. More importantly, it carries way less risk of the fund provider just abruptly closing up shop. Look for funds that have been actively trading for at least 5 years, ideally 10 or more. You want proof that they've survived some real chaotic market conditions. Okay, part 3, advanced metrics. For those of you who want to geek out just a little bit, let's look under the hood at the mechanics of the most efficient ETFs. First up is tracking. An index ETF has one job: copy its index perfectly. So you want a low tracking error, meaning it rarely deviates from what it's supposed to be mirroring. Next is liquidity. Because ETFs trade like stocks, there is a tiny gap between the buy price and sell price, known as the bid-ask spread. For the big, boring ETFs we just talked about, the spread is basically zero, which is exactly what you want. Third is replication, which is just a fancy way of asking how the fund holds its assets. Physical replication is the gold standard for your core. It means the fund actually holds the underlying stocks, rather than using confusing synthetic derivatives. Finally, income. When companies pay out dividends, distributing funds hand that cash straight to you. Great if you're living off it. But accumulating funds? They automatically reinvest those dividends right back into the fund, which is an absolute game changer for seamless compounding while you're growing your wealth. Part 4. The 3-fund portfolio. You absolutely do not need 30 different funds to be a successful investor. Honestly, a simple, elegant portfolio using just 2 or 3 broad funds is all you genuinely need to build incredible long-term wealth. Take a look at this mock setup. 60% in a total U.S. market fund, 20% in a total international fund, and 20% in a total bond fund. That is literally it, the whole shebang. It completely cures choice paralysis. You instantly own thousands of global companies and have the reliable stability of bonds, all while keeping your fees as close to zero as humanly possible.
Which brings us to our final section, Part 5. 5 costly mistakes. This is all about playing defense. Mistake number 1 is chasing expensive, hot thematic trends instead of sticking to your boring core. Look, every single year there is a shiny, new, next big thing. Robotics, AI, cybersecurity, the list goes on. But here is the cold, hard truth. By the time a theme is popular enough to get its own expensive ETF, the easy money is almost always gone. You are essentially buying in at the peak. Mathematically, a broad, boring core is the far superior approach. Mistake number 2 is something called diversification. This happens when well-meaning investors think they are being incredibly safe by buying 10 to 15 different ETFs. But what they don't realize is that underneath it all, those funds often hold the exact same mega cap stocks. You really aren't diversifying at all. You're just creating overlap and doubling down on the same handful of companies without adding a shred of real protection. One single total market ETF is vastly better for genuine diversification. Mistake number 3, ignoring bonds completely. I see this all the time, especially with younger investors who want maximum growth and write off bonds as being way too boring. And sure, bonds typically offer lower returns than stocks, but their purpose isn't aggressive growth. Their job is emotional stability. When the stock market inevitably takes a nosedive, high-quality bonds hold the line. They act as the anchor that prevents you from absolutely panicking and liquidating your stocks at the bottom. Mistake number 4 is trying to time the market. Time in the market beats timing the market. It is a massive cliche, I know, but it's a cliche because the math backs it up. Trying to sell right before a crash and buy back in at the exact bottom is literally a fool's errand. The data proves over and over that even the pros fail at this. Why? Because the stock market's biggest, most explosive gains often happen in just a handful of entirely unpredictable days. If you're sitting in cash trying to time the perfect entry, you are going to miss those days and your long-term returns will be absolutely crushed. Just stay invested. And finally, mistake number 5, assuming the letters ETF somehow magically guarantee safety or diversification. Let me be clear, they absolutely do not. A single country ETF or a hyper-specific sector ETF carries massive concentrated risk. And leveraged ETFs, the ones that use debt to multiply daily returns, those are incredibly dangerous tools built strictly for short-term day traders, not long-term wealth builders like us. In a volatile market, they can and will destroy your capital. Always open the basket and see what's actually inside before you buy. So, I want to leave you with this final thought. You've got the mentor's playbook now. You understand the 3-step filter, why keeping costs fiercely low is a game changer, and exactly what costly traps to dodge. The real work right now is simply starting and staying the course. So, what's it going to be? Will you sit on the sidelines and let inflation quietly rob you? Or will you take action and start building that beautiful, boring core today? I really want to know. Run your ideas through the filter and drop your go-to core ETF down in the comments. I read every single one. Keep learning, keep growing your wealth, and I'll catch you in the next explainer.